Welcome to the Deep Dive, brought to you by FutureLink. In this deep dive, we're going to unpack the One Big Beautiful Bill and what it really means for the finance industry. Everything from, big banks and investment firms down to financial advisors and, well, your own everyday money decisions.
Exactly. Our goal here is pretty simple. Cut through all the legal jargon, make this complex legislation easy to grasp. We want you to walk away feeling confident about its impact and, what's actually in it for you. And just to be clear, everything we're discussing today comes straight from the official bill text and government resources. No guesswork here.
Perfect. So where should we start? Maybe with the banks and financial services. There seem to be some big shifts there.
Yeah, good place to start. One of the first things is about the Consumer Financial Protection Bureau, the CFPB. Its funding cap is being adjusted downwards from 12% to 6.5%.
Okay. And what does that mean practically? Less funding means?
Well, it could signal a shift, maybe a narrowing of focus for the CFPB, perhaps more emphasis on certain areas or maybe, relying a bit more on the industry to self-regulate.
Yeah.
It's definitely something for financial institutions to watch.
Right. A subtle but important change in the regulatory winds. Okay. What else? I saw something about sending money overseas.
Ah, yes, the remittance tax. There's a new tax being introduced on remittance transfers that's basically money sent to other countries.
So if I send money to family abroad, it might cost more?
Potentially, yes. The companies that handle these transfers, they'll be collecting this tax. Though it's worth noting, funds coming from, say, regulated U.S. banks or U.S. debit and credit cards are generally exempt, so it depends on how you send it.
Okay, that's a key detail.
And another thing, this one impacts small businesses, online sellers. The rules for reporting transactions through third-party networks like payment processors, they're changing.
Changing how? I know that's been a bit of a headache for some.
Right. Well, the reporting thresholds are going back up significantly. Think over $20,000 and more than 200 transactions. So for many smaller sellers, this means less paperwork, less reporting burden. But note, this change only kicks in after December 31st, 2025.
That sounds like good news for the gig economy and small online shops, definitely. Gives them some breathing room. And I also saw an incentive tied to rural lending.
Yes, exactly. There's a new tax break, essentially. A 25% exclusion on interest that qualified lenders receive from loans backed by rural or agricultural real estate.
So they're trying to encourage banks to lend more in those areas?
Precisely. It's a clear incentive for banks to, invest more in rural and agricultural sectors.
Okay, let's shift gears a bit. What about investments and business incentives? Any major changes there?
Oh, quite a few. First off, some key community development programs are getting a big boost to stability. We're talking permanent renewal and enhancement for opportunity zones, the low-income housing tax credit, that's LIHTC, and the new markets tax credit, or NMTC.
Permanent renewal, that's huge. Those programs rely on predictability, right?
Absolutely. Making them permanent really helps investors plan long-term for community development, affordable housing, job creation in distressed areas. It provides that certainty.
Makes sense. And for startup investors, I heard something about QSBS.
Qualified small business stock, yeah. Big news there. The amount of gain you can exclude from tax is jumping up to $15 million.
$15 million, wow.
Yep, and it gets adjusted for inflation after 2026. This is really significant for angel investors, venture capitalists. It changes the math on investing in early-stage companies. Could drive more capital to startups.
Definitely one to watch.
Then there's something new called qualified minor beneficiary accounts. You might hear them called Trump accounts colloquially. Think of them like individual retirement accounts, IRAs, but for kids under 18.
Okay, like a savings account for minors?
Sort of, but with specific rules on what you can invest in, mainly low-fee mutual funds, tracking major indices like the S&P 500. The idea is to encourage long-term saving for young people.
Interesting. And on the green energy front, any finance implications?
Yes. Related to clean energy tax credits, there are new restrictions involving what they call prohibited foreign entities, plus penalties for getting the facts wrong, for misstatements. So for anyone financing or investing in green tech projects, it means more careful checking, more due diligence is needed.
Right. Got to cross those T's and dot those I's carefully. Okay, how about the insurance world? Any ripples there?
A couple of things, mainly focused on agriculture. The subsidy for crop insurance premiums is going up from 65% to 80%.
So more support for farmers facing risks.
Exactly. Better safety net. And there's also a brand new poultry insurance pilot program being set up, so specific help for that sector too.
Okay. Now let's pivot to what this means for individuals for personal financial planning. That SALT deduction change sounds like a big one.
It really is. The state and local tax deduction limit. It's being modified. We don't have the exact final details in this overview, but the intent is clearly to ease that limitation.
Which could mean real tax relief for people in states with high income or property taxes.
Potentially, yes. It could put, a significant amount of money back in some taxpayers' pockets.
And other deductions, too.
Yes, several new ones. The bill aims for no tax on qualified tips.
No tax on tips.
That's the plan outlined. Also, no tax on qualified overtime pay, starting after December 31st, 2024. And another one, no tax on car loan interest, again, for tax years, starting after December 31st, 2024. Direct reductions to the tax burden for many.
Those sound like very direct impacts. What about student loans? Always a big topic.
Big changes there, too. Federal direct PLUS loans for graduate and professional students. Those are set to end after July 1st, 2026. And there will be new annual and aggregate borrowing limits for the federal direct unsubsidized Stafford loans.
So, potentially tighter limits on federal student borrowing for higher ed.
Seems that way. But there's also some relief included. If a student loan is discharged because of death or permanent disability, that discharged amount won't count as taxable income after December 31st, 2025.
That's a compassionate change. Removes a potential tax burden during a really tough time.
Definitely. And finally, a few things on health-related finances. Changes are coming to how premium tax credits are verified and the rules about paying them back, the recapture rules. That starts for plan years after January 4, 2027.
Right. Something to watch for people using the health insurance marketplace.
Right. Also, good news for health savings accounts, HSAs. The rule allowing telehealth visits before meeting your deductible, that's being made permanent. And interestingly, bronze and catastrophic health plans can now qualify for HSAs if they're paired with something called a direct primary care service arrangement. More flexibility there.
Wow. Okay. That covers a lot of ground across the whole financial landscape. And just a reminder, this deep dive was created by FutureLink using AI and automation tools, pulling directly from those official bill documents we mentioned.
Yeah, and if you're interested in how AI and automation could help your own business navigate complexity like this, feel free to visit us at futurelink.com, or you can just email training@futurelink.com.
Thanks so much for tuning in to The Deep Dive.
Stay informed, everyone. Using these modern tools really can help you stay ahead in the fast-changing worlds of business and finance.